Silver just surged to 94.53, up more than 41% in a single month. On the surface, that looks like another speculative blow off. Another metals rally driven by traders chasing momentum. But if you stop looking at the price on the screen and start looking at what's happening underneath in the physical market, in supply chains, and in mining economics, a very different story begins to emerge. This isn't just a fast move higher. This is a pricing mechanism starting to break. Because here's the first quiet red flag almost no one is talking about. In a normal rally, physical premiums fall. When price rises fast, sellers flood the market. Supply loosens. Premiums compress. But right now, silver premiums are doing the opposite. They're rising at the same time the price is exploding. That combination is extremely unusual. It tells us that even at Dune 94 silver, real metal is still hard to source in size. The screen price is saying, plenty of silver. The physical market is saying, not enough silver. And those two messages should never diverge like this. Now zoom out and think about what that implies. Silver trades on paper at multiples of the actual physical supply. For every ounce of real metal, there are dozens, sometimes hundreds, of paper claims, futures contracts, ETFs, unallocated accounts, synthetic exposure. That system only works as long as most people never ask for delivery at the same time. But when physical demand tightens while paper prices surge, the system begins to experience stress. You start seeing delivery delays. You start seeing rising premiums. You start seeing inventory drawdowns. These are not speculative signals. These are plumbing signals. And this is where the story gets even stranger. If silver is really at 94, then silver mining companies should be printing money. Their margins should be exploding. Their valuations should be re-rating violently higher. But that isn't happening. Most silver miners are still trading at depressed multiples, as if silver were still at 25 or 30 EU. That disconnect is not normal. In past silver rallies, miners front ran the metal. This time, they're lagging badly. And that lag is not random. Let's walk through simple math. The average all-in sustaining cost for many primary silver miners sits somewhere between A18 and 25 per ounce. Even if we assume higher costs, say 30 per ounce at a 94 silver price, that implies gross margins of over 60 per ounce. That is an extraordinary margin for any commodity producer. On paper, these companies should be generating massive free cash flow, paying down debt, launching buybacks, and raising dividends. Yet the equity market is barely reacting. That tells us investors don't trust this price. Or more precisely, they don't trust the structure behind this price. And that brings us to the deeper issue. The silver market today is not being driven by miners and fabricators. It's being driven by derivatives, ETFs, and synthetic liquidity. The price discovery mechanism is happening almost entirely in paper markets, not physical ones. So what happens when physical constraints start pushing back against paper pricing? You get exactly what we're seeing now: rising prices, rising premiums, shrinking inventories, and equity markets that refuse to believe the signal. This is why this rally feels fundamentally different from 2011 or 2020. Back then, silver spiked on speculation, inflation fears, and monetary panic. But physical inventories were still ample. Premiums were contained. The system could absorb the demand. Today, inventories are already thin. Mine supply has been flat for years. New projects are scarce. Capital discipline has replaced expansion. And industrial demand from solar, electronics, and defense is structurally higher than it was a decade ago. So when people say, this is just another silver bubble, they're missing the core difference. This is not speculation colliding with speculation. This is paper promises colliding with physical constraints. And now look at the miners again through that lens. The market isn't ignoring their profits. It's discounting the durability of the pricing regime. Investors are quietly signaling that they believe this silver price is unstable, not too high, but structurally unsound. that it is being set in a market that may not be able to honor physical delivery at scale if stress continues to rise. So we now have three signals moving in opposite directions. The screen price is exploding higher. The physical market is tightening even more. And the equity market is refusing to confirm either one. That triangle of divergence almost never lasts long. Eventually, one of those three has to snap back into alignment. Either physical supply loosens dramatically, or silver prices fall sharply, or miners violently rate higher as the market finally accepts that these margins are real and durable. But what cannot continue is this quiet contradiction between paper pricing, physical availability, and corporate valuation. And this is why this moment matters more than most people realize. Not because silver is at 94, but because the internal mechanics of the market are starting to flash structural tension. Silver just moved to 0.94, 53 in less than a month. That number alone is enough to make headlines. But the real story is not the speed of the move. It's the behavior of everything around it. Because when a market moves this fast, something underneath usually breaks first. And right now, several things already have. Start with this. In a functioning commodity market, price leads behavior. When prices surge, sellers appear. Scrap comes out of hiding, inventories refill. Premiums fall. Stress disappears. That is how the system is supposed to self-correct. But silver is not doing that. Instead, the higher the price goes, the harder physical metal becomes to source. Premiums are rising. Delivery times are lengthening. Large buyers are quietly paying above spot just to secure supply. That is the opposite of what a healthy rally looks like. That tells us something uncomfortable. The price is not clearing the market. It is failing to attract real supply. And that's where the tension begins, because silver is not just another metal. It sits at the center of two worlds that don't talk to each other. One world is paper, futures, ETFs, unallocated accounts, derivatives. That's where the price is made. The other world is physical mines, refineries, mints, fabricators. That's where the metal actually exists. Those two worlds are supposed to stay synchronized. When they stop, the price becomes a story instead of a signal. Right now, they are drifting apart. Look at inventories. Global above-ground silver stocks have been quietly declining for years. Mine supply has gone flat. New projects are scarce. Grades are falling. Costs are rising. Meanwhile, industrial demand keeps climbing, not cyclically, but structurally. Solar panels, EVs, data centers, military hardware, medical equipment. Silver is being consumed, not hoarded. Once it's used, it doesn't come back easily. So when price explodes higher and inventories keep shrinking, it creates a silent imbalance. The market is screaming abundance. Reality is whispering scarcity, and here's where it gets even stranger. If silver were truly 94 in a stable, durable way, the silver mining sector should look like a money printing machine. These companies pull metal out of the ground for roughly $20 to $30 an ounce. At 94 silver, that's margins north of $60 per ounce. That is an extraordinary profit structure. In any rational market, capital would be flooding into these stocks. Valuations would be re-rating violently higher. CEOs would be announcing buybacks, dividends, and debt paydowns. None of that is happening. Most silver miners are still trading as if silver were $30. That is not a small mispricing. That is a message. The equity market is telling you it doesn't believe this price. Not because it's too high, but because it doesn't trust the mechanism producing it. Investors are acting as if this price lives on borrowed time, as if it exists inside a structure that cannot support it. And that brings us to the core risk almost nobody wants to say out loud. The silver market is priced in a paper arena that is many times larger than the physical market itself. For every real ounce, there are layers of claims stacked on top of it. Futures, ETF shares, unallocated credits, synthetic exposure. The system only works because most people never ask for metal at the same time. But what happens when physical demand tightens at the exact moment financial demand explodes? You get rising premiums, you get inventory drawdowns, you get delivery delays, you get arbitrage failures, and eventually you get a credibility problem. Because at some point, someone has to ask a very simple question. If silver is really worth 194, where is it? This is why this rally does not look like 2011 or 2020 or any past spike. Those were fear rallies. This is a supply structure rally. Back then, metal was available. Today, it isn't. Back then, miners could expand. Today, they can't. Back then, inventories were deep. Today, they're thin. This is not speculation colliding with speculation. This is paper promises colliding with physical constraints. And now look at the triangle forming in the market. The paper price is surging. The physical market is tightening. The mining equities are refusing to confirm either one. That triangle cannot stay open forever. Either physical supply suddenly loosens, or silver collapses back down, or mining stocks violently re-rate higher as the market finally accepts that this price is real and durable. But one of those three has to move. And when it does, it will not be gradual. That's why this moment is dangerous in a way most people don't understand. Not because silver is high, but because the internal logic of the market is starting to contradict itself. When markets start disagreeing with themselves, they don't drift sideways. They resolve violently. Silver just did something that should not be happening quietly. It didn't just rise. It didn't just break resistance. It didn't just shock traders. It moved into a price zone that fundamentally changes the economics of the entire silver industry, and almost nobody is acting like it matters. That silence is the first warning sign, because at a 94, 53, silver is no longer a metal trade. It becomes a system-level variable. At that price, it alters mining incentives, refinery behavior, industrial procurement strategy, and even government stockpile logic. And yet the market is still treating this like another fast chart move. That mismatch between price and behavior is where instability begins. Here's the strange part. If silver were truly abundant, this price would already be collapsing under its own weight. Scrap would be flooding in. Industrial buyers would be stepping back. Secondary supply would surge. That's how commodity markets self-balance. But none of that is happening. Instead, industrial buyers are accelerating orders. Mints are struggling to keep up. Fabricators are quietly locking in forward supply. That tells you demand is not reacting to price the way it's supposed to. Which means the market is not being cleared by price. It's being rationed by availability. That is a very different regime. Now consider this. Silver is not consumed like gold. Gold gets hoarded. If silver gets destroyed, it gets soldered into circuits, embedded into panels, coated onto glass. Once it's used, it's gone. And for the last decade, the world has been building technologies that require more silver per unit, not less. Solar alone now consumes a material share of annual mine output. Defense demand is rising. Data center demand is rising. Medical demand is rising. So the world is pulling more silver into irreversible uses at the exact moment mine supply is no longer growing. That's not a cycle. That's a structural drawdown. Now layer one more detail on top of that. Most silver is not mined from primary silver mines. It comes as a byproduct of copper, lead, and zinc mining, which means silver supply is not responsive to silver prices. Even at the 94, miners don't suddenly produce more silver unless copper and zinc economics justify expanding operations. So the normal, high price fixes high price mechanism doesn't even work here. That means silver is one of the few commodities where price can go vertical and supply barely moves. That's rare and dangerous. Now pause and think about what the futures market is actually pricing. It's pricing a world where anyone who wants silver can get it. Instantly. In size, at the screen price, with no friction. No delays, no bottlenecks, no shortages, no premiums. That world no longer exists. which means the price you're seeing is not a clearing price. It's a reference price inside a stressed system. And now we reach the most unsettling signal of all. Large industrial buyers are no longer trusting spot markets. They are negotiating off market supply deals. They are paying fixed premiums. They are locking in multi-year contracts. That behavior only happens when buyers are more afraid of not getting metal than of overpaying for it. That is not how people behave in a bubble. That is how they behave in a shortage. And now look at financial positioning. Hedge funds are heavily long. Retail is piling in. Options volume is exploding. That all looks speculative. But at the same time, vault inventories are drifting lower. Refinery lead times are lengthening. Bar availability is tightening. That combination almost never happens. It means financial demand and physical demand are rising together, not canceling each other out. That's a pressure cooker. Now here's the paradox nobody wants to touch. At a 94 silver, the metal is screaming scarcity. But the silver mining stocks are screaming disbelief. They are not behaving like companies sitting on $60 margins. They are not being valued like strategic suppliers. They are not being treated like cash flow machines. They are being priced like this entire move is temporary. Like it's an illusion created by leverage and derivatives. So now we have a four-way contradiction. The price says silver is rare. The physical market says silver is tighter than the price implies. Industrial buyers are acting like silver is strategically scarce. Equity markets are acting like none of this is real. Markets cannot live inside contradictions like this for long. And this is where things stop being theoretical. Because if this price is even partially real, refineries will start hoarding feedstock. Fabricators will run orders. Governments will quietly restrict exports. Strategic buyers will remove metal from the open market. That behavior doesn't show up in headlines. It shows up as sudden vanishing liquidity. And once that starts, the screen price stops mattering. Because at that point, the real price becomes, what are you willing to pay to get metal right now? That is how commodities break away from financial pricing. Something unusual just happened in the silver market, and almost everyone missed why it matters. Not because silver hit the 94.53, but because of what didn't happen after it did. When any commodity moves this far, this fast, the system normally breathes a sigh of relief. Supply shows up, bottlenecks ease, volatility drops. The market stabilizes itself. That's how price is supposed to work. It's a signal that invites balance back into the system. But silver didn't rebalance. It tightened. That's the first clue that this is not a normal rally. Because right now, the higher silver goes, the less flexible the market becomes. Liquidity is thinning. Delivery windows are stretching. Product availability is narrowing. The system is behaving like it's under strain, not like it's being rescued by high prices, which raises an uncomfortable possibility. What if this price is not high enough? Not in speculative terms, in structural terms. Think about how modern supply chains actually work. Industrial buyers don't wake up every morning and buy silver at spot. They operate on contracts, lead times, hedging programs, and guaranteed delivery schedules. Their risk isn't price. Their risk is interruption. If silver becomes unreliable, entire production lines stop. And right now, reliability is quietly deteriorating. That's why something subtle but critical has started happening behind the scenes. Procurement departments are no longer optimizing for lowest price. They're optimizing for certainty of delivery. They're paying up to secure allocation. They're locking supply months and years in advance. They're reducing exposure to spot markets. That behavioral shift only happens when a market loses credibility. And credibility is far harder to rebuild than supply. Now zoom out. For decades, silver has been treated as a secondary metal. Abundant, replaceable, easy to source. That assumption shaped everything from just in-time inventories to massive paper leverage built on top of tiny physical buffers. But that world depended on one condition, that silver could always be pulled forward from somewhere else. That condition no longer holds. Global mine supply is stagnant. Ore grades are declining. Environmental permitting is slowing projects. Capital expenditure has been starved for over a decade. And most silver doesn't even come from silver mines. It comes as a byproduct, which means higher silver prices don't unlock supply the way people assume. So we now have a market where demand is structural, supply is rigid, inventories are thin, and price discovery happens in a paper arena detached from physical flow. That combination is unstable. And now look at how different groups are behaving. Retail traders are euphoric. Hedge funds are leveraged long. Options markets are pricing chaos. But industrial buyers are acting defensive. Refineries are acting cautious. Fabricators are acting nervous. Those two worlds are reading the same market and reaching opposite conclusions. That divergence never lasts. Because eventually, someone has to test whether the silver behind the contracts actually exists. And that's where the real danger enters the story. The silver market is not designed for mass delivery. It is designed for netting and rolling and cash settlement. It works only as long as physical demand stays marginal compared to financial demand. But what happens when industrial demand starts competing with financial demand for the same limited metal? You don't get a higher price. You get a delivery problem. And delivery problems don't resolve with charts. They resolve with force majeure clauses, with export restrictions, with emergency stockpiling, with sudden rule changes. That's not theory. That's how every stressed commodity market eventually behaves. Now here's the part almost nobody is modeling. At a 94 silver, the value of above ground silver inventories becomes strategically significant, not just financially, geopolitically. Silver becomes a material input into energy security, defense readiness, and digital infrastructure, which means governments don't need to announce anything for behavior to change. They just need to stop selling. And if even a few large holders quietly withdraw metal from circulation, the float collapses. That's when price stops being a number and starts being a negotiation. And now look again at silver mining stocks. They are not priced for a world where silver is strategic. They are not priced for a world where supply is rigid. They are not priced for a world where physical scarcity drives policy. They are priced for a world that no longer exists. That mispricing is not random. It's the market's way of saying, this system cannot support what this price is implying. Which leaves us with a final, uncomfortable question. What if the silver market is not rallying, but malfunctioning? What if the price is not discovering value, but signaling structural failure? Because in healthy markets, price moves restore balance. In broken markets, price moves expose fragility. At $2.94, 53 an ounce, silver just crossed into a price zone that rewrites how the entire market is supposed to function. But the most important change didn't happen on a chart. It happened in behavior. And almost no one is paying attention to that part. Because when a commodity becomes this expensive, three things normally happen. Producers rush to sell. Buyers step back, inventories rise, volatility cools. That's how markets release pressure. But silver just broke that pattern. Buyers are becoming more aggressive. Sellers are becoming more selective. Inventories are not rising. They're thinning. That is not how a rally ends. That is how a constraint reveals itself. Here's the deeper problem. Silver is being priced like a financial asset, but it is being consumed like a strategic material. Those two identities are colliding. Every modern growth industry now depends on silver. Solar panels, power grids, AI data centers, missiles, satellites, medical diagnostics, advanced batteries. None of those sectors care what silver costs. They care whether silver shows up on time. And right now, delivery reliability is quietly deteriorating. That shift changes everything. Because once buyers stop optimizing for price and start optimizing for certainty, the market stops being elastic. It stops responding to higher prices the way economics textbooks say it should. Instead of demand falling, it hardens. It becomes inelastic. Buyers pay whatever they must to avoid production shutdowns. That's already happening. Which means this market is no longer being cleared by price, it's being cleared by allocation. And that is a dangerous transition. Now consider something almost nobody talks about. The global silver market is small, tiny relative to capital markets. The total annual mine supply is worth less than the market cap of a single mega tech company. That means even a modest shift in institutional capital or a few strategic buyers' front running supply can distort the entire price discovery process. This is not a deep liquid market. It's a thin, fragile one. Now layer this on top. For decades, the silver market has been stabilized by one assumption: that scrap supply would surge at high prices. Old jewelry, electronics recycling, industrial recovery. That secondary supply was supposed to act like a pressure valve. But modern silver usage broke that valve. Today's silver is embedded in micro layers on circuit boards, fused into solar cells, vapor deposited onto glass. It is not economically recoverable at scale. The scrap surge people are waiting for can't materialize the way it used to. So the invisible safety net under this market is gone. Now look at the supply side. Silver mining is not expanding. It's aging. The average silver mine is older, deeper, lower grade, and more expensive to operate than it was 10 years ago. New discoveries are rare. Permitting timelines are measured in decades. And because most silver comes from non-silver mines, higher silver prices don't actually unlock new production. So the supply curve is rigid. Demand is structural. Inventories are thin, and price discovery happens in leveraged paper markets. That combination has only one historical outcome: instability. Now let's talk about something even more unsettling. The silver futures market is still priced as if large quantities of metal can be delivered on demand. But physical throughput capacity, refineries, mints, logistics, vaults, is nowhere near large enough to support mass delivery, which means even if the metal technically exists somewhere, it cannot move fast enough to meet a delivery surge. That is not a shortage problem. That is a system design problem. And system design problems don't resolve with higher prices. They resolve with rationing. Now zoom in on one quiet signal. Refiners are extending lead times. Wholesalers are limiting order sizes. Mints are delaying shipments. None of that makes headlines, but it's how physical stress announces itself. And now comes the most dangerous illusion in this entire story. The illusion is that this is still a trade. That silver is something people are flipping for profit. That it will naturally come back down once momentum fades. But markets don't behave like that once they cross into strategic relevance. At that point, metal stops circulating freely. It gets absorbed into long-term hands. And once that happens, liquidity doesn't come back. It disappears. That's how small commodity markets break. Not with a crash, with a vacuum. Now ask yourself this: if you were running a national power grid, or a missile factory, or a solar panel supply chain, and you saw silver behaving like this, would you wait for prices to fall? Or would you quietly lock in supply at any cost? That decision is already being made. And it doesn't show up on price charts. It shows up months later as unexpected shortages. 8 the 94, 53 an ounce, silver just entered a zone where normal market rules stop working. But the real danger isn't that silver is expensive. It's that the market is acting like it doesn't fully understand what it just did. Because when a commodity crosses a threshold like this, it forces hidden decisions to the surface. Decisions by miners, by manufacturers, by governments, by institutions. And those decisions don't show up in price immediately. They show up as sudden silence. And the silver market just went quiet in all the wrong places. Here's what should have happened by now. High prices should have unlocked supply. Scrap flows should have surged. Warehouses should have started refilling. Delivery times should have shortened. Volatility should have cooled. None of that happened. Instead, order sizes are being capped. Lead times are stretching. Bulk availability is thinning. Off-market deals are increasing. Buyers are quietly being told, we can't guarantee that volume. That is not how a bubble behaves. That is how a market behaves when it's running out of slack. Now think about this. Silver is no longer just a commodity input. It has quietly become a timing critical dependency. If silver shipments fail to arrive, production lines shut down. Missed delivery windows don't just delay products. They cascade through supply chains. And once reliability breaks, price becomes irrelevant, which is why something subtle but terrifying is happening right now. Industrial buyers are no longer treating silver as a price risk. They're treating it as a continuity risk. And continuity risks change behavior in ways charts can't capture. Because when continuity is threatened, buyers stop waiting, they stop negotiating, they stop trusting spot markets, they start hoarding, they start pre-buying. They start removing metal from circulation. That's how shortages accelerate invisibly. Now layer this on top. The silver market is structurally small. The entire global physical float is tiny compared to capital flows. It doesn't take much institutional reallocation or strategic procurement to drain visible inventories. Which means the market doesn't need panic to break. It only needs quiet, coordinated caution. And that's exactly what this looks like. Now here's the part almost nobody wants to talk about. The futures market is still pricing silver as if delivery is a formality, as if metal can be summoned on demand, as if physical throughput is infinite. It isn't. Refining capacity is limited, minting capacity is limited, transport capacity is limited, vaulting capacity is limited. So even if silver technically exists somewhere, it cannot be mobilized fast enough to meet a delivery surge. That means this market is one delivery shock away from a credibility crisis. And credibility crises don't show up gradually. They arrive overnight. Now zoom out even further. Silver supply is rigid. Demand is structural. Inventories are thin. Recycling is inefficient. New mines take decades. Byproduct production doesn't respond to price. So the system has no fast acting stabilizer, which means once stress enters, it can't leave. And now look at the strangest contradiction of all. At 94 silver, miners should be in a valuation supercycle. But they're not. They're being priced as if this entire price regime is imaginary. As if it's being generated by leverage, not scarcity. That tells you something crucial. The equity market is subconsciously saying, this price is not stable enough to build a future on. Which means capital is not expanding supply. Which means supply will not grow. Which means the very thing that could relieve this tension is being delayed by disbelief. That feedback loop is lethal. Now here's where the story turns dark. At some point, a large industrial buyer or sovereign entity will decide not to risk the spot market anymore. They will remove a massive block of silver from circulation in a single transaction. That deal will never be public. But its effects will be, suddenly, liquidity will vanish, premiums will spike, quotes will disappear, delivery promises will get revised, and everyone else will realize, too late, that the metal they thought existed was already spoken for. And when that realization hits, something irreversible happens. People stop selling silver for money and start selling money for silver. That is the moment markets flip from trading mode into survival mode. And that moment doesn't come with a warning label. It comes with a failed delivery notice. Something deeply abnormal is happening in the silver market, and it has nothing to do with charts, headlines, or technical indicators. It has to do with behavior. Because at $94, 53 an ounce, silver just crossed into a zone where the market should be calming down. Instead, it's becoming more unstable. That is the opposite of what price is supposed to do. When prices rise this fast, they normally destroy demand. Buyers hesitate. Projects get postponed. Substitutes get explored. The system decompresses. But silver is doing the reverse. Demand is becoming more urgent. Orders are being pulled forward. Buyers are acting as if time itself has become the scarce asset. That behavior only appears when people stop trusting future availability, which means something fundamental has changed quietly. Now think about how silver is actually used. Not as bars in vaults, not as coins in safes, but as microscopic layers inside electronics. As coatings on glass, as conductive paste in solar cells, as irreplaceable components in weapon systems, satellites, and medical imaging equipment. Once silver enters those products, it does not come back. It vanishes from the market permanently. So every year, a massive volume of silver is destroyed by industrial use. And that destruction rate is now accelerating. At the same time, mine supply is not. That imbalance is invisible on price charts, but it compounds relentlessly. Now add something even more destabilizing. Most silver is not mined because people want silver. It's mined because people want copper, lead, and zinc. Silver just shows up as a byproduct. So even if silver goes to 150, production barely increases unless base metal mining expands too, which means silver has one of the most rigid supply curves of any major commodity. That makes price spikes far more dangerous than people realize. Now here's where the story gets uncomfortable. The silver market is still being priced as if supply is flexible, as if higher prices will magically summon new metal, as if warehouses are full, as if scrap flows will surge, as if logistics have infinite capacity. None of that is true anymore, which means the current price is not clearing the market. It is masking a physical bottleneck. And bottlenecks don't resolve gradually, they resolve violently. Now notice something subtle. Large buyers are no longer asking, "What's the price?" They're asking, "How much can you actually deliver?" That question marks the death of a normal market, because once availability replaces price as the primary variable, money stops being the control mechanism. Allocation becomes the control mechanism, and allocation always favors the largest, quietest, and most strategic players, which means the public price becomes a fiction. Now zoom out. The entire global silver market is tiny. The annual supply is worth less than what a single mega fund can deploy in a week. So if even a handful of sovereign funds, defense contractors, or tech giants decide to secure long-term supply, they can drain visible inventories almost instantly. And they would never announce it. They would just do it. And everyone else would find out later, through missing metal, through rising premiums, through canceled deliveries, through unexpected supply disruptions. That's how shortages announce themselves. Now here's the most dangerous misconception in this entire story. People think a commodity crisis looks like panic buying and empty shelves. It doesn't. It looks like quiet procurement, silent hoarding, and vanishing liquidity. It looks like markets that still trade normally until one day they don't. And by the time the public notices, the float is already gone. Now look at one last contradiction. At the 94 silver, miners should be treated like strategic assets. They should be national security level suppliers. They should be trading at extreme premiums. They are not. They are being valued like this entire price regime is temporary, which tells you something terrifying. The market does not believe this system can hold, which means capital is not expanding supply, which means supply will not grow, which means the pressure building right now has no release valve. Now we reach the final problem. The silver market is built on contracts, not metal, on promises, not inventory, on leverage, not reserves. It only functions if most people never demand delivery. But what happens when industrial buyers, governments, and financial players all want the same physical ounces? That's not a pricing event. That's a failure event. And failure events don't come with countdown timers. They arrive as routine settlement notices that suddenly aren't routine anymore. Silver at E94, 53 is not the story. The story is what people are quietly doing because of it. Because markets don't break when prices move fast. They break when behavior changes and nobody notices. And silver behavior just changed. Not in trading rooms, in procurement offices, in refineries, in logistics desks, in government stockpile departments. That's where the real shift is happening. Here's what should be happening right now, and isn't. High prices should be scaring buyers away. They should be delaying orders, searching for substitutes, drawing down inventories, waiting for the market to cool. Instead, buyers are accelerating purchases. They're front-loading contracts. They're locking future delivery. They're paying fixed premiums. They're refusing to wait for spot pullbacks. That behavior only appears when buyers stop believing future supply will be there, which means the market just lost trust in itself. And that is far more dangerous than volatility. Now consider something most people never think about. Silver doesn't live in vaults anymore. It lives inside things. Inside solar panels that can't function without it. Inside servers that can't transmit data without it. Inside guidance systems that can't miss. Inside medical scanners that can't fail. Once silver goes into those systems, it is effectively removed from the global market forever. So, unlike gold, silver is not being recycled into circulation at scale. It is being permanently destroyed by modern technology. That means every year, the global silver supply is shrinking in real terms. And that shrinkage just crossed a critical threshold. Now add the supply side. Silver production is not growing, it's decaying. Mines are aging. Grades are falling. Capex has been starved for over a decade. Permits take longer than political cycles. And most silver isn't even mined on purpose. It shows up as a side effect of copper.